Hi there, and good morning, and welcome to the Canadian MoneySaver webinar. I'd like to welcome Ian Burns and Shelley Johnston from the Pension Specialists today. Thank them for coming in on a Saturday afternoon, Saturday morning for some of you. They're gonna talk about their trademark topic, and that is pay attention to your pension. They're going to discuss the various pension options that you have that will help help you retire and transition into retirement. So I'd like to welcome them. I'm going to unmute them right now, and I hope all of our attendees get some great information out of this. And again, I'd like to thank Shelley and Ian for taking time for us today. One moment. Ian and Shelley, it's all yours.
Thank you.
Thank you, Anna. Good afternoon, everyone, and thank you for joining us. We hope that today's webinar will inspire you to take control of your retirement years by giving you the confidence and equip you with the right questions to ask about your pension and the available choices you have.
As millions of baby boomers head towards retirement, not enough are paying attention to their pensions. Many people over 50 have been overwhelmed with information on retirement, wellness strategies, anti-aging products, and adult life housing amounts, and other things.
Many other things.
For over a decade, we've sat with our clients approaching retirement, and to be quite honest, those who are newly retired and all too often those who are already retired, they've all had one thing in common. They're worried and they're even terrified about what lies ahead. Retirement is about the transition between living your life and living a lifestyle. By paying attention to your pension, you can shape the lifestyle of your choice in the next quarter or third or even the next half of your life. Retirement then becomes not a backing away from life, but definitely a way of going forward.
There are basically two types of registered pension plans. Can you name your plan? The first plan may be a defined benefit or maybe a defined contribution. The key to understanding your plan is all in the name. With a defined benefit plan, the income you receive at retirement is predetermined. In other words, you can expect a predictable stream of income in retirement for your life. A defined contribution plan is not quite like that. It is based on the contributions made over the years and the earnings these investments have made, and instead of a guaranteed income stream for life, you retire with a pot of money, and it is your responsibility to manage an income stream. In other words, the risk is on you, not on the company, like with a defined benefit plan. Knowing which type of plan you have and understanding how it works will help you determine how it can contribute to your retirement income.
In order to help you to plan for your retirement, it's really important that you understand and realize the impact of those so-called subtle changes and what they have on you and have on your family. If you're a member of a defined benefit pension plan, it is incumbent upon you to pay attention to your pension. Pension plans, not just in Canada, but throughout the world, are all facing the same challenges. Longevity. By the late 1990s, workers began to live more retirement than anyone predicted. Thus, an essential piece of the pension puzzle equation is that the average worker's career is supposed to be significantly longer than their retirement years. For example, back in the 60s, people worked for 35 or 40 years and retired at 65, not 55, and many were dead by 75. Now look at the teacher's pension, for example. Did you know that there were over 126 teachers in Ontario only over the age of 100? And for many plans, the average retiree will spend more time collecting their pension than they did contributing to them during their working years. For example, the average years for teachers collection of pension is 31 years, while their average years worked is only 26. A complete reversal from when the pension plans were first designed. Over the next few years, we're going to see the largest exodus in history as more and more and more baby boomers retire. This demographic shift also has a major impact on pensions. When pension plans were first designed, the ratio for active members versus retired members was around about 10 to 1. Now this is almost reversed, where you have more plan members retired, drawing a pension from the plan, than those who are still actively working and contributing to the plan. The plans in the most danger are those plans that are no longer accepting active members. Lower interest rates, higher community values. A low interest rate environment means that pension plans need to set aside more money to fund future pension, and those who take community value means that those values are at a record high. Because of all this, pension formulas are being tweaked to reduce future pension liabilities and, in the long run, make pensions more sustainable. If you're in a public pension and you think you're safe, you can think again. How can people ask the taxpayers to fund public pensions when many of those taxpayers are struggling with their own financial issues and don't even have pension plans themselves? It's obvious that many things are going to change moving forward.
Now let's learn about your pension plan. Your company pension plan is an essential part of your financial future. It is important to understand how your plan works and what benefits you will receive. Things that you need to know and things that we're going to cover throughout this webinar today is talk about what is your monthly pension amount? Is there a bridge benefit? Does this increase every year with inflation? And what does that mean? What is the formula used to calculate your monthly pension? What about early retirement provisions, penalties? Is there a survivor portion? Do you have options here? Most importantly, is your pension guaranteed? And if so, by whom? Reviewing your pension statement. Is everything still current and accurate? Ensure there are also no ex-spouses lurking in the shadows. You'll be amazed how many pension statements we see, and we look and ask who this person is, and we find out it happens to be an ex that has never been removed. Don't let that happen to you. Your annual pension statement gives you a detailed snapshot of your plan membership and helps you see the formulas apply to your individual circumstances. Therefore, make sure you keep your pension statements in a safe location. They are valuable financial documents.
Now let's talk a little bit about retirement. When and how much? If you've got a defined benefit plan, what's your factor?
85 or 90?
Retirement can be based on your normal age. For some, this is age 60. For others, it is age 65. There are two types of early retirement. One is an unreduced early retirement, and the other is a reduced early retirement. Depending on your age and the credit in the pension plan, you may be eligible to retire before age 65 with an immediate unreduced pension. For example, your age 55 and your service of 30 years equals 85. And that would be the factor in your pension plan. If you meet the factor, then you qualify for early retirement with an unreduced pension. If you don't qualify, you can still retire early, but your pension may be substantially reduced.
So early retirement, is it worth it? How much at age 60? So in this example, if you retire and you take a 25% penalty reduction, your unreduced early retirement pension would normally have been about $42,000. Now, because you've retired early and you have not met the factor, in this example, we've shown a 25% reduction, which is basically about 0.5% per month between your actual retirement date and age 60. So we've got a 5-year difference here. So that $42,000 annual pension reduces to $31,500. That's quite a big hit that you're taking for retiring early. If you retire before age 65, some plans have an auxiliary benefit called a bridge benefit or special allowance. For those who are fortunate to have a bridge benefit included in their formula, you will notice that when you turn 65, your pension is reduced. This is to reflect the integration with CPP, and even if you take CPP before age 65, your pension will not be reduced. Not all plans have this benefit, but typically we see with defined benefit plans, your income is made up of 2 parts. The first part is the basic pension. The second part is the bridge benefit or special allowance to age 65. Again, every plan has different rules, so check your plan out. On a side note, if you apply for CPP disability pension, the rules are different here, so seek professional advice. Also, when it comes to the survivor option, some pensions provide a survivor benefit on the bridge portion as well. Others may not, and unfortunately, many do not. So make sure you understand what the survivor portion is based on.
One of the major concerns many of our clients have is understanding the actual formula of your pension plan. And not only do you need a factor which is based on age and years of service, but the formula will then provide you the means to calculate your pension. There are 4 types of formulas for defined benefit plans. The first one's a flat benefit, the second one being career average, or best 5 or best 3 years, and the other one being a final average. Flat benefit pension plans are typically for unionized employees. Many of these plans are called MEPs, multi-employer pension plans, and they provide a specific amount of benefit for each year of pensionable service. So the longer an employee works with a participating employer, the greater the pension payment. Career average plans are a little bit different. With the career average formula, your benefit is based on your earnings over the entire time you were a member of a plan. If you've been with your employer for many years and moved up the salary bands, you could end up with a significantly lower pension than under the final average formula.
So for example, in our screen here, this formula is based on the career average, and you can see the 2% formula times the years of service times the career average, which is the salary over the time period. So in this example, the basic annual pension is $30,000. Now let's look at the next slide where we compare that to the final average.
Yeah, in this example, a member earns a lifetime pension equal to 2% times 30 years of service. The average best 5 years being $70,000. All of a sudden, the pension is now $42,000, a substantial increase from the career average. Finally, we have a best earnings plan, and these plans traditionally have the pension benefits based on the best 3 or 5 years of earnings. Overall, then, best earnings and final earnings plans will provide you with a better pension benefit to employees than the flat benefit or career average plans, simply because they relate more closely to the higher earnings you can expect to earn later in your employment career.
This is where we sometimes see people all of a sudden that have never been in management, and if their pension is based on the last 3 or 5 years, they will make a sprint to go into management roles because they're making a higher salary, and that will really make a difference in their pension over the long run.
Yeah, and then one of the things now that we're finding an overview in the pension world is what they're now starting to do is they're now starting to tweak some of the formulas. For example, here's a subtle change. Instead of a 2% average, let's assume we now drop this down to 1.85 as the formula. We'll now see that the pension is 1.85 times 30 years of service over 70,000, which gives you a basic pension of 38,850, which is substantially less than the actual 2% formula.
The 42,500.
Yeah, and what you've really got to look at is to understand that that $4,000 difference is going to run for the life of your pension plan.
And keep in mind, when many of these plans first started, the percentage used was only 1.67. This has gradually increased over the years. It is estimated that the proposed change, like the above, going from 2% to 1.85, would actually save a plan millions over the next 10 years, depending on the size of the plan.
One of the things that Shelley and I have been doing is we've been doing a substantial work with many pension plans and many pension funds, and we're now getting a solid handle on some of the changes that you can expect moving forward. And these changes are so subtle that nobody really knows the end result, and that's why you should be paying attention to your pension.
The value of indexing. Indexing is a valuable pension benefit because it protects your buying power over the years. This chart illustrates how pensions without indexing erode the value to you over time. It compares a monthly pension of $1,000 at 3% inflation over 10, 20, and 30 years. And it compares with and without indexing. Things to watch for is that many plans are now eliminating indexing altogether, or they are slowly implementing subtle changes so that instead of 100% inflation, they are now reducing that to say 50 or 70% of the current inflation rate. So for example, if this year's inflation rate is 2%, instead of your pension increasing by 2%, they may say you'll get 50% of that, so it will only increase by 1%. But when you look at this chart, you can really see the difference of $1,000 that has eroded over 20 years. It's worth $544. That's a substantial hit. And then if you look at the far column, the same pension that grew with inflation is now worth $1,806. So you can really see the value of indexing. And if you don't have indexing on a plan, this is where you need to take a step back and really do some proper retirement planning, because 20 years from now, you're going to need additional resources from somewhere.
It should also be said that because inflation today is low, most people are saying that, well, that's no problem, we can make the adjustment. But if you look at the lifetime, if you look at stats over your lifetime, we all know that one of these days inflation's going to come back, and it may come back with a vengeance.
And a proposal like this of eliminating indexing on pension plans would ease the funding pressures. For example, a plan like OMERS, who integrates a slight change like this, could save the plan close to $2 billion over the next 10 years.
We have been working with many people that have these indexed pension plans, and it's interesting because when you look at the commuted value on a pension plan that's indexed, if you take the indexing off, for some of these plans are going to reduce by as much as 20% on the commuted value. It just shows you the actual costs of inflation to the companies.
Survivor options. Choosing the best possible survivor option can be tricky. This example demonstrates the monthly pension that would be paid to their surviving spouse based on 60, 65, 70, and 75% survivor pension. It also shows the reduction to the member's pension when more than a 60% survivor pension is provided. The reduction to the pension changes in some plans depending on the member's age and the spouse's age. The most common option is usually 60%. This is usually what we call the default option. But again, many plans have different survivor options. Some are 66.66%. This is something you have to check about your plan. When it comes time to retire, this is one of the biggest questions we get is what survivor option I do. So there's a lot involved in taking and choosing the correct option.
The other thing you've got to look at when you're looking at survivor's options, many pensions give you the survivor's option on the basic pension, but not on the bridge benefit or not on any of the supplementary benefits. Again, these are things that if you do have a defined benefit pension plan, these are things that you've got to check out.
Another thing to be cautious about with survivor options is that some plans indicate that you must apply at least 2 years before your pension begins to provide an enhanced survivor pension with no medical proof. If you apply within 2 years of your retirement, many require proof of medical, and the pension plan does have the right to approve or disapprove this request. Note, you can cancel the higher survivor benefit at any time, up to 1 month before the pension starts, but not after. And once you, that basically means that if your spouse dies before you do, you can continue to receive the reduced pension. So you have to really be aware of what your health issue is, what your longevity is. All that plays a major role in choosing the survivor option. And again, check out your pension plan.
And the other thing that you've also got to look at, again, what if you don't have a surviving spouse? What is the default option? Is there a benefit there for your children? Many plans today have a benefit if your child is a special needs child and dependent on you. Again, you've got to get the facts and you've got to check out your pension. The other thing that we've really got to look at is basically to protect your retirement security. Let me take you back a little bit to about 2008, 2009, just after we had the market correction. All of a sudden, a lot of these pension plans went into the wind-ups and solvency issues. And again, there wasn't enough money in these pension plans. So here's the thing that you've got to look at. A plan is in a shortfall position when it doesn't have enough funds to meet its long-term pension obligations. Solvency ratios, they compare assets to liabilities on a planned termination basis. Value of certain benefits may be excluded, like indexation. One of the pension plans that we're working with here in Ontario, they put out the solvency ratios, but ultimately the pension is indexed and they have excluded the value of the indexation, which for us is maybe a little bit dishonest. They're giving you the information, but they're certainly leaving a huge portion of the solvency out there. And of course, solvency ratios may result in accelerated funding for underfunded plans and more frequent filings with the government. Remember, what we've now seen in a lot of these pension plans is the government have taken a step back and looking at additional money to cover solvency, not over the usual 5-year period, but they're actually extending that period out for 10 years. Wind-up valuation compares assets to liabilities on a planned termination basis, but includes the value of all benefits. Assumptions are based on current market conditions. Therefore, the lower the interest rates, the lower the bond rates, for example, the higher the value has to be in the pension plan going forward. Member count and demographics are also important. This is where we check for the number of active members, their average age, and many plans are reaching the tipping point versus those who are retired. The retiree's average age and the average monthly pension. By tipping point, what we mean is more and more we're seeing pension plans where there's more people receiving pensions than people that contribute into the plan. If there came a time that plan assets and future contributions were projected to be insufficient to fully fund plan benefits, it may be necessary for future benefits to be cut back.
And remember, Ian, back in the 2013, I think it was early 2013, the Supreme Court of Canada has ruled against pension plan members of bankrupt Ontario companies, saying they do not have priority over secured creditors. So in other words, you as a plan member are at the very bottom. Once everybody gets paid out, you will get the crumbs.
Yeah. One of the things that we've been working for, there's a large automobile dealer in Ontario that's having some, or automobile company, I guess, it's having some pension plan issues. And it's really interesting because this company was too big to fail, and through that they haven't contributed any money into the pension guarantee fund. And if the pension goes insolvent, there's no guarantees.
There's also another large company out there as well, where right now anybody taking commuted value out of the pension, and we'll talk about that a little later, they're actually not permitted to take out 100% of their commuted value. They're only actually getting what the pension plan is currently worth, which is 48%. So they're only getting 48 cents on the dollar, and then they have to sit back and wait over a 5-year time frame to see what else they'll be possibly able to get.
Yeah. So again, it's really, really incumbent on anybody that has a defined benefit pension plan, even a defined contribution pension plan, to make sure that you are paying attention to your pension.
So, getting ready to retire. If you're over a certain age or within 10 years of your normal retirement, your pension may only have one option when you go to retire, and that is to keep your money in the plan and receive a monthly pension payment for the rest of your life. You may have other choices. Yes, you may. And these are things you need to take a look at. You may have the option of taking the commuted value of your pension plan as a lump sum. The commuted value is the amount of money invested today, which would, under prescribed assumptions, grow to be exactly sufficient to provide the pension under the pension option as above. The commuted value is calculated by an actuary, and the actuaries must follow the guidance provided by the Canadian Institute of Actuary Standards of Practice for these types of calculations. It's not up for the individual company. In particular, there is specific direction given with respect to the selection of assumptions to ensure standardization of commuted values across pension plans. For example, you have the interest rates. All those interest rates, whether your plan is indexed or not indexed, those are standardized rates that are used right across board.
It's kind of interesting. And what's the benefits of a monthly pension? Years ago, it was really kind of interesting because most monthly pensions or pension plans, defined benefit plans, but when you retired, you got a gold watch and peace of mind. Every morning you could wake up and there would be a check under your pillow. Today, many pension plans are giving pensioners sleepless nights. However, hypothetically, a monthly pension should provide you with peace of mind. No investment worries. You don't have to worry about investing your money within the market. However, you've got to be careful of where your pension plan's monies are invested. Is this pension guaranteed for life? Maybe yes and maybe no, depending on the plan. And it's interesting because one of the things that we speak about is public sector pension plans. And right across Canada, what you're now looking at is you're looking at changes to these plans. Traditionally, there were grandfather clauses. Both Shelley and I are in agreement that there could be changes. But again, getting back to the monthly pension, many provide good survivor options.
And this can be a positive or it could be a negative.
Depending on if you've got a survivor or not.
That too, but it could also be when you look at some of the survivor option. If you have a 50% survivor option, that's the only thing you can provide for your spouse, and if something happened to you prematurely, unfortunately, the other expenses when you pass away don't get cut. Hydro doesn't care, and they're not going to cut the heating bill by 50%. The property taxes aren't going to be paid, or cut by 50%. So for some, it's a positive. For others, it's a negative.
And again, it's all part of how people should be planning. Most monthly pensions, and particularly in the public sector, have had some form of inflation protection. Now, this is a good news, bad news, because many people have seen their pensions increase substantially over the past several years with inflation. The bad news is that we believe that this inflation protection is going to stop. If it doesn't stop, it's going to be substantially reduced. Negative side.
So why people don't like to take the monthly pension is at the end of the day, when both you and your spouse are gone, there's no legacy. There's nothing to leave to a favorite charity or to your family. It can be inflexible. Once you turn the pension tap on, you can't turn it off. Or another way it's inflexible is the fact that we all know life happens. All of a sudden you need a new roof. You need 20 grand. Where are you going to get that money from? Unfortunately, you can't call the pension plan and say, could you please, lend me 20,000 out of my pension money. They won't do that. As we mentioned, the survivor option sometimes can be a negative. And of course, if there is no inflation, the loss of purchasing power.
The other thing that we've now got to look at when you're looking at your pension is, let's assume you decide that you're going to take the commuted value. Now, the commuted value means, I'm out of here, give us cash. Traditionally, under a defined benefit pension plan, a portion of your money gets transferred into what we call a locked-in retirement account. Again, the major benefit here is you can leave a legacy to your spouse and children. It's flexible. You can take additional money out for your purchasing power, and there's a surviving option. So your survivor would get 100% of the locked-in account. Unfortunately, there's a huge tax situation depending on your situation.
And your age.
And your age. And again, the other thing is you might run out of money before you run out of life.
Especially those who are not disciplined. Remember one who downsized?
Oh yeah. We had a client who downsized and still ended up with a $250,000 mortgage that he didn't have before he downsized.
He downsized the size of the house, downsized the size of the property. Unfortunately, went and had a custom home built. It's beautiful, but it came with a big price tag.
And again, over the long haul, what does that mean? You might have a good lifestyle today, but ultimately this house will need to be sold to provide them with lifetime income. One of the other things that you look at in commuted value is investments. If you take the commuted value out and you invest your money, the good news is you can have growth, maybe even more growth in your pension plan. The bad news is you may have more losses. Again, it all depends on the individual. And of course, when you take the commuted value in the event of your premature death, your survivor gets a lump sum, and can your survivor handle the money or look after it? Probably one of the least known options in a defined benefit pension plan is a commuted value to the annuity.
This is one of those best kept secrets. An annuity is the same as taking your monthly pension. The main difference is that the monthly income comes from an insurance company, not the underlying pension plan. In other words, you're transferring the risk from your underlying company that you're currently working with to an insurance company. And for pensions, like some of the major automotive companies who no longer have the protection or the safety net of the Ontario Pension Fund Guarantee, there is added protection. How does that protection come? Well, there is a nonprofit organization called Azurus. So if something happens with the insurance company, your monthly income stream is guaranteed by 85% or $2,000 a month, whichever is higher. So for many who are concerned with the underlying pension plan not being able to provide future benefits, an annuity mirrors that pension plan, but takes the risk from the company over to an insurance company.
Yeah, so just to take a step back here, supposing you're ready to retire, supposing you want a guaranteed income, hypothetically looking at it, you know that your company that you're working from is having financial difficulties. You look at the pension fund and you see that your pension is only maybe 48, 50, 60% funded, and there's not a lot of money going in to the pension plan. You now don't have any confidence in the company that you used to work for. So the first thing that you want to do is to say to yourself, well, I don't want to be a member of the pension plan, but I want a guaranteed income that I was looking forward to after working for 30 years for ABC company. So what we would be looking at would be taking this commuted value and saying, okay, now we're going to mirror your own pension, but instead of the liability being with the company, we're now going to give it to people that are used to handling pension funds, which is an insurance company. This option is certainly one of the most underutilized, but probably one of the best options for many retirees in this day and age.
Exactly, but you do have to be careful when choosing this option, as you do need to stay and follow the rules within the Pension Benefits Act and the Income Tax Act.
Yeah, and that's an interesting thing, Shelley, because when we look at it, we've been doing a lot of work with retirees that are taking the commuted value to the annuity, and there is a step and process, and you've got to make sure that you follow this process, because if you don't and your plan goes offside, all of a sudden you're going to be faced with a huge tax bill and several other issues.
So let's look at now you're getting ready to retire. You may be 10, 5, or 3 years, or even months from retirement. Now is the time to clarify what's important to you as you move forward with the next quarter of your life. So how does one plan for the future when it's next to impossible to forecast what the future will look like? Here are some tips to help you transition into a successful retirement. Reduce debt. Interest rates aren't going to stay this low. They're going to go up eventually. Understand your cash flow. Know what your income is and know what you spend. We find this is the most trickiest for pre-retirees, is really getting a handle on what your life looks like. What are your expenses? What are your income coming in?
I think too, Shelley, one of the keys that you look at is that most retirees for the first 18 to 24 months, in a lot of cases, go a little bit crazy.
Yes.
They've got a financial strategy, they do a budget, cash flow, this is where retirement goes. And then it seems as if they throw it out the window for the first couple of years, spending money on this, spending money on that. And it's only really until once they balance into retirement,
once they settled in, exactly.
That's where everything runs. One of the things that we look at is that you need to really pay attention to your pension to understand how your pension works and how the government pensions work. Be prepared. The other thing that you've really got to do is to choose your retirement date carefully. Make sure you're ready physically, emotionally, and financially. And more importantly, one of the things that you've got to understand is your investment strategies. Understand how your investments work and how would you incorporate your savings into your retirement strategy.
If you work on all these, we have no doubt that you'll be able to face the future with confidence. Taking any action to better prepare for retirement is better than doing nothing. We would like to leave you with an excellent question to ask yourself.
Yeah. one of the things that we will be available to answer questions after this webcast. So if you do have any questions, you can type them. We do have an email address, which is pensionspecialistinfo@pensionspecialists.ca. But let me look at it. Just before we sign off, both Shelley and I are part of an organisation called the Strategic Coach. And Dan Sullivan created this question for us, which we create for our clients. So I'd like you to think about this.
And sorry, Ian, before you ask the question,
yeah.
One of the things that we always recommend to our own clients is that when you go to ask this question, it's always best to be somewhere where it's very quiet. And I know in this day and age it's very hard, but I'm asking to get rid of all your electronics, get rid of your technology, your iPhones, your iPads, the computer. Maybe sit in a very quiet, relaxing room, and most importantly, have a pen and yes, a piece of paper, and of course, a favorite drink to help you put you in the right frame of mind.
So here's what you got to look at. It's the 13th of September, and it's 2017. If we were looking back over the last 3 years, what would have to happen in your lifetime, both from a financial and a personal perspective, for you to feel happy with your progress? For example, Shelley, what would have to happen in a 3-year?
In 3 years, well, for many people, when they are looking back over this 3-year time frame, if they're in the midst of transitioning from retirement, they want to ensure that everything has gone very successful, that they have just nicely gone into retirement. They now basically are no longer fighting traffic. They put the BlackBerry or iPhones aside, and they're now getting back to what they really wanted to do many years ago, maybe back when they were a teenager. Maybe they started doing puzzles. They picked up curling.
Traveling more. Maybe the financial situation is such that they've transitioned, their budget, they're earning a good income,
they're volunteering,
pension-wise,
giving back to the community.
Maybe they're helping their kids, their grandkids. And these are the keys that you look at, because our belief when we talk about retirement is you've got to retire to something as opposed to from something.
And one of the things that we also use to help answer this question is something called our DOS. Dangers, opportunities, and strengths.
Okay. Dangers. There's only 2 things that keep you awake at night. One is what you're worried about, and the other one's what you're excited about. A lot of our clients' dangers going into retirement are really financial concerns. Will there be enough money? Will you run out of money before you run out of life?
There may be health concerns.
Health issues. We could have taxation issues. Is your pension right or wrong? What options are you going to take with your pension?
And how are your adult kids? Are they financially stable, or are you helping fund them? We have a saying for that.
Kippers. Kids in parents' pocket.
Eroding retirement savings. So don't become a kipper.
Yeah, don't let your kids become kippers.
Yeah, you don't want the kids in your pocket.
But anyway, one of the things that we would suggest that you do is, now that we've went over the pension strategy, we've talked a little bit about goals and setting some goals and strategies. It's incumbent upon anybody planning for retirement to really understand and pay attention to their pension.
Thank you for joining us today, and I hope you've been able to learn more about what to look for in your pension, and that we have inspired you to take control of your future, because your future may depend on it. We also wrote the book on pensions, so to order your copy, please send us an email. We're giving a show special, $20, tax and shipping included, at info@pensionspecialists.ca. And of course, thank you to Canadian MoneySaver and they have their information on their about their subscription as well. And if anybody has any questions, if you'd like to type them in now, that would be great.
We have a question from one of our listeners, and it's strategies to minimize taxes. This is kind of interesting because both Shelley and I are big believers in the 3Ds of tax planning. One is to deduct, the second is to defer, and the third one is to divide. Under current laws, if you have a pension plan, for example, and it's a defined benefit pension plan, you can actually income split your pension with your spouse up to a maximum of 50%.
And that applies to those who also take the annuity option. If you take the commuted value to an annuity, the income splitting rules apply for that, and there's no age restrictions.
If you're under 65 and take commuted value
to a locked-in retirement account.
Yeah, the after-tax portion, for example, will be tax advantaged, but you won't be able to income split on that side. The other thing too is when you're looking at it, as you're growing your retirement money or planning for retirement, again, this is when you should strategize to minimize taxes. Old favorites, maximize RSPs, look at spousal options. One of the most underutilized investments today is actually a tax-free savings account. People use this like a cash account. We tend to talk to our clients about a tax-free income that would supplement their pension money. So you save in the tax-free savings account and then you take it out to supplement your income. So these would be some strategies to minimize taxes.
Another strategy is once you both are collecting Canadian Pension Plan, CPP, you can also start looking at sharing your CPP.
Perfect.
So I hope we've answered that question. And it looks like we have another one.
Okay. The question that we have here for Ken. Ken is asking, the rules have changed on CPP. Does it still make sense to draw your CPP early? The old rule being roughly 7 to 8 to break even. We're big believers that when we run the numbers, so there's two questions that we ask. One is that the time question, which means traditionally it's between 76 and 78 that you would break even. But the other one that we see a lot is that when you have a spouse, a surviving spouse, there's a maximum amount that your spouse can receive as a pension income over and above the survivor benefit. So when you have a spouse and your spouse is receiving maximum pension from the CPP, there will be no survivor benefit to her when she starts drawing CPP. Many of our clients withdraw their money early so that the guaranteed pensions and the survivor benefit will go to the spouse in the event of premature death.
Again, for many with CPP, it's a very individual decision whether to make, so we basically look at the whole picture as well. What are all your income sources? For some people, they're forced to take CPP early because they need the additional income. For others, they don't want to delay it because otherwise they're going to give up some government benefits. So there's a lot of financial planning.
And the other side too, Ken, when you're looking at it, if you take early CPP, it may affect your income flow for clawback for old age security when you turn 65, or if you're young, when you turn 67. Okay, any more questions here? Let's see if there's anything.
Okay, it looks like that's all the questions for today.
Thank you very much for listening.
If a question does happen to come up after we're off the air, by all means, please do not hesitate to email either Canadian MoneySaver or ourselves directly. Thank you for joining us.
Take care.